Hey guys, Christos here and welcome back for another video. In today's video, I'm going to be sharing every single thing that you need to know to be able to start investing into the stock market. This video is primarily going to be aimed at the beginner investor, but if you have been investing for some time, then do stick around as I will be dropping some golden nuggets throughout this entire video. But having said all that, all I ask for you guys is to leave this video a like down below to help this video out with the YouTube algorithm. Share it with a friend who you think would find this video useful as well, and let's get straight into it. Okay, so let's start things off with what is investing and why do we need to do it? So looking at it from an official definition point of view, investing is simply the process of allocating resources, usually money, with the expectation in the future of generating an income or a profit. There are many different ways that you can actually invest. For example, you could go with a fixed interest investment with your bank account. You could also invest into alternative assets like gold, silver, and other precious metals. You could potentially invest into property and real estate. And the one that we're going to be talking about today, you can invest into something called the stock market. But why should we be investing in the first place? Well, investing is important because it's actually a way of taking charge of our financial future. If we didn't invest and make our money work for us, instead we left it in something like a bank, throughout the years as inflation continues to rise, what would effectively happen is the money that we have in our bank would effectively become worth less and less every single year. So if anything, investing actually isn't about getting rich quick or generating lots of money for some people. Investing is simply sometimes just about keeping up with the way that the world is moving. And when it comes to the reasons that people have to invest in the first place, I feel that there are four main categories. You have number one, the person that simply invests just to beat the yearly inflation, like I just mentioned. You then have somebody that would invest to reach a certain financial goal. Maybe they're looking to buy a house, or maybe they're just looking to invest to potentially buy or go on a nice holiday in the future. You then have somebody that invests that is looking to build a nice long-term retirement fund that they can retire on in the future. And then finally, you have somebody that is investing for those high interest returns that is of course looking to make lots of money. For me personally, I believe that all four of those I kind of fit into, and these are all my different goals in life. But for everyone, investing can be a different purpose and everyone has a different goal. So that's basically what investing is, why people invest and why it's actually so important. What I did say in this video, what we're going to be focusing on is investing into the stock market. So let's start there. And when it comes to the stock market, there are three main types of investments that you can actually make. First off, we have individual stocks. Now, this is where you simply buy a share of a company, and what you essentially do is become a part owner of that business. For example, if I wanted to buy 10 shares of Apple stock, that would simply mean that I am now buying a slice of that company. A very small slice, I must admit, because Apple is actually currently valued at $2.5 trillion, but nonetheless, you are actually becoming an owner of that business. Investing into individual stocks is known as the most common way of investing into the stock market, but there are actually a couple of other ways as well. And the next way is something called funds. So basically, when it comes to investing into a fund, instead of buying one share and owning one company, what you effectively do is buy a share in a fund, and what they will actually do is give you access and investments into multiple companies. For example, a fund that I currently invest into at the moment is a fund that tracks the top 500 companies in the United States. And basically, when I buy one share of that fund, what my investment actually gets split up between is 500 of those companies in smaller fractions. Investing into funds are of course a great way to limit your risk. They are much less riskier than investing into individual stocks, and they are a great option for those that don't really have the time to do too much research into individual stocks as well. And then finally, what you have is investing into something called a bond. And simply, when you invest into a bond, what you are basically doing is loaning money to a business, and then in return, they are going to be giving you a fixed interest payment over a certain time frame. These are typically known to be the least riskiest out of the types of investments that you'll ever make. However, when it comes with less risk, of course, what is going to come with that is less reward. But all in all, they are the three main types of investments that you can make within the stock market. For this video, I am primarily going to be focusing on individual stocks, but I do have other videos on this channel that focuses on both bonds and funds. So when you've finished this video, if you were interested in checking out those, then I'll leave them in the description down below. Okay, so now we know what an individual stock is. The next thing to know is, how does an actual company get their shares and actually make them available to us as everyday investors? Well, the first thing that they need to do is become what is called a public company. So basically, when you form a business, there are two types of companies that you can form. You can either form a private company or you can form a public company. Now, most of us, when we start a business, we are going to be starting off as a private company. For example, the corner shop that you go ahead and grab your bread from in the morning is likely going to be a private company. And what this means is nobody from the public can actually invest into that company. Of course, if you were the owner of that business, you could go out and seek private investors. So maybe you could approach your friends or colleagues or maybe your family and ask them to invest into your business, but you won't be able to list your company on a stock exchange, which we'll get to in a moment, for other people and the general public to invest in your company. However, if you do decide to become a public company, basically what you are doing is making your company public to the entire world and allowing them to invest into your company. And simply, when this happens, the place where the shares of your company will live is something called a stock exchange. And basically, a stock exchange is a centralized location where the shares of a public company can simply be bought or sold on a daily basis. There are many different types of stock exchanges all over the world. For example, in America, you have something called the New York Stock Exchange, which of course hosts a lot of the top American companies. In the UK, we have the London Stock Exchange, which hosts companies from the UK and potentially Europe as well. And then in Japan and China, you have the Tokyo Stock Exchange, which can obviously host companies over that side of the world. However, despite these companies and their shares being listed on these different types of stock exchanges, people like me and you and everyday investors still cannot just go waltzing into one of these stock exchanges and start buying shares. So how do we do it? Well, this is where stockbrokers come into play. And all a stockbroker is basically an intermediary between the stock trader or investor, so us, and the stock exchange. These intermediaries are authorized to buy and sell shares on our behalf, and in return, most of them will charge a small commission for doing this. Now, in the days without the internet, this actually used to be a lot more difficult to do. If you wanted to buy shares on a stock exchange, what you would actually have to do is physically call up a stockbroker, transfer their money that may take a couple of days or maybe even up to a week to get into their account, and authorize them to go ahead and buy your stocks for you. However, now with the day and age of the internet, what we have the luxury of is online stock brokerages where we can simply now go ahead, sign up, and within 5 minutes be trading on a stock exchange, which is absolutely fantastic. One online stockbroker I highly recommend is Freetrade. This is actually a commission-free trading platform, and if you did want to go ahead and use Freetrade as your stockbroker or platform, you can go ahead and click on my link in the description down below, and if you were to deposit £1 onto the platform, you will actually get a free share worth anything between £3 and £200. One thing I have to say is that I will also receive a free share as a thank you from Freetrade for referring you as a customer. But all in all, a stockbroker is somebody that you can instruct to buy and sell shares for you, and a stock exchange is a centralized location where all the shares of different companies live depending on the countries that they're situated in. Okay, so now we know where the shares of companies actually live and how we can actually go ahead and buy and sell them. Let's actually talk now why sometimes the stock market goes up and sometimes the stock market goes down and the causes behind this. So when a company first decides to go public, what they actually do is set a certain amount of shares that they want to offer to the public. This is commonly known as an IPO, which stands for an initial public offering. And then from there, the way that the company's stock price will decide whether it's going to go up or down is through the old case of the simple supply and demand. The more people are buying stocks in a company, the more the stock's price is going to go up, and the more people that are selling the company, the more the stock's price is going to go down. This is extremely simple, and this is exactly how the stock market works on a daily basis. But of course, there are going to be some catalysts which are actually going to cause more buying activity and more selling activity. So let's get into them right now. To make people want to potentially buy more shares of a company, the way that this could happen is potentially if that company was reporting really good earnings figures. So by law, public companies have to report every single quarter, and they also have to report annually. Now, if they release their statement and it shows that their company is growing and they are producing extremely good financials, this is of course going to tempt investors to potentially want to invest more into that company. Another reason that could make people want to invest more is some positive news and future outlooks of a company. So if they had some really good press releases, this could obviously excite investors to want to invest into that company in the future, and of course that would lead to the stock price going up. On the flip side, you could have something creep in which is called FUD, which stands for fear, uncertainty and doubt. And basically, if an investor at any point feels a little bit fuddy about a stock, I've just made that up by the way, then basically that could potentially tempt them to selling their stock, eventually causing that stock to go down if enough people did it. In terms of the things that could potentially create FUD in the market, it's just simply the opposite of the things that I just spoke about. So if a company was reporting really bad financials, this could cause investors to be tempted to sell the stock, or maybe some really bad press releases, or maybe something in the court of law changed that stopped this company from operating in the way that they did change. These are all different things that could create FUD around a certain stock or company. But in summary, as a whole, the thing that causes the stock price to go up and the stock price to go down is simply supply and demand of the shares that are available. So knowing all of this, how do we actually make money from investing? Well, there are two main ways. Number one, you have the capital growth in your share price, and then number two, you have something called dividends. With number one, it's very straightforward. Let's say you bought one share of a company that was worth $100, and then over the next year, that company's share price was to go up $50, so that share was worth $150. Now, if you decided to sell that stock right there and then, you would have made a $50 profit or 50% return on your investment. And then with number two, you can also actually receive quarterly payments and annual payments from a company in the form of a dividend. Basically, all a dividend payment is a set percentage of the company's profits that they will pay back to their investors simply as a thank you to say thanks for investing into our company and allowing us to grow and operate. So there you go. Now we know how to make money from the stock market and what actually causes the stock market to go up and down. Let's now talk about some of the risks of actually investing into stocks. And basically there is only a couple of risks, but they're quite big ones anyway. When you invest into stocks or any kind of investments, of course, the potential of losing your money is going to be there. For example, a company that you're investing into could potentially go bankrupt in the future. This means that if you had any shares in that company, it would pretty much just turn to dust straight away. And then secondly, you have something called a stock market crash, where this has nothing to do with the individual company's performance. It more so has something to do with the general economy. And basically, if the economy is going down, what normally happens is this just causes all of the different stocks in a market to go down with it as well. In terms of the last major stock crashes that we've actually experienced, we did actually see one at around kind of May, April time of 2020, which was a semi-stock crash, I would like to say, but the last major or official stock crash that we experienced was the one of 2008. But realistically, the only risk when it comes to investing into the stock market is simply the risk of losing your money. However, if you decide to invest sensibly, diversify your portfolio, invest into solid companies that you know can cope with these general market downturns, then the likelihood is you are going to be okay in the long run because you have developed a good investing mentality. But having said all that, that is pretty much everything that you need to know to get started investing into the stock market. If you did want to dive deeper into some of the different ways to invest, or maybe even find out some of the companies that I personally invest into, then what I'm going to do is leave a link to a playlist up here and in the description down below of my investing series on YouTube. But having said all this, like I said at the start, I would really appreciate it if you found this video valuable, then to like this video down below. And if you did have a friend that you wanted to share it with, then go ahead and do that. Of course, if you did have any questions down below, leave them in the comments section and I will catch you guys in another video. Take care.